Hello. Hello.
Hey, hi, Forum.
Yes, hi. How are you?
Good, good. How are you?
Yes, fine. Yeah,
So,
you
can
are
you,
audible.
and you can see my video as well.
Yes, yes.
Okay. And I'll be sharing my deck.
Okay.
So, let me just see how I can do that. How do I do that on Zoom?
There is a share option, share screen option,
One second. More security
at the
recording
bottom of the screen.
at the bottom of the screen. Okay. Uh, I can't see it actually. Achha, I can see. I can see. Hang on. Share content, screen. So, Komal, Forum, can you see my screen now?
Yes.
Sorry, I didn't hear it.
Yes, yes, it is
Cool.
visible.
Oh, perfect. Great. Thank you so much.
Yeah.
Uh, Forum, can I just ask you one thing? Is it possible for you to share your screen? Because when I'm sharing the screen, I can't see any of the participants because I can see only my presentation.
I will just call you.
Sure.
എന്ത് ഇന്നലെ പറഞ്ഞിട്ടുണ്ട്.
Good evening, everyone. We will start in 5 minutes. Good evening, everyone. We can start now with the session. We have with us Mr. Mehul Palaria.
Uh,
Welcome,
th-
Mr. Mehul Palaria.
sure. Thank you, Forum. So, good afternoon, good evening to everyone. My name is Mehul Balaria, and I will give you a quick overview of what I've done over the last few years in my career. So, I started my career with CARE Ratings, which is a credit rating agency. I was working there in both. I was covering the corporate sector as well as the financial institution sector. Within the corporate sector, I was covering the infrastructure, power, and the telecom companies. Within the financial institutions, I was rating the banks at CARE. After CARE, I spent a couple of years in equity research. First as an analyst at ICICI Securities, and then as a lead analyst at Centrum Broking. After spending a couple of years in equity research, I actually worked with a company called Adventity, which is now Sutherland. They're essentially into the offshoring business. So they do KPO, which is a knowledge process outsourcing, and I was part of the research and analytics vertical there. Then they do the operations function, and they were also doing the voice business. The last 11 and a half years, actually from March 2008 till October 2019, I was actually in JP Morgan, and I was in the credit risk management organization at JP Morgan. I was handling a couple of teams at JP Morgan. First, I handled the CAU FIG Asia team, which is CAU stand for Credit Analysis Unit. Now, the team covered financial institutions counterparties of JP Morgan across Asia and the entire breadth of Asia Pacific. All the several countries where JP Morgan would have exposure to. Then the last in about 4.5 years, I was actually heading the corporates team within CAU, which is about a 55 member team. The team was covering essentially all large corporates from a credit standpoint across both EMEA, Asia, and North America. I moved out of JP Morgan in November 2019, and I've been kind of working on a couple of things. They're still, I would say, midway, so wouldn't be able to disclose much about that. But yeah, they're kind of in the space which I wanted to do for a while. Now, Forum, would you be able to share my deck?
No,
Sorry?
actually, that's what I will not be able to share it. So if you can just try.
No, so I'm unable to share, and then when I move out, I'm not able to see the screen. So, okay, let me do one thing. Let me just share my deck, and I'll share it in a minute. So, for I think that's okay. I'll share it and I'll just manage it at my end. So, guys, I want to just I was talking to Aditya, and I did design a couple of training programs in my previous organizations, largely from a credit perspective. So this is something which I do essentially over a 2 or a 3 day period. When we have new team members who join. So, and the way I've always done is that I've done all of these trainings online, as in, not really online. I've done all these trainings actually offline, and specifically in the classroom, where I can see the audience, I can see their reaction, I can see their participation. This is sort of my first time doing it technically online, and I think everybody's got used to working online now. So what I would request is, if I will speak for 2 hours, it's going to be a monologue, and I don't know about you guys, but I will definitely fall asleep. So maybe I will take a pause at a few moments, in which case I would request the participants to kind of unmute their phones and then share their thoughts, their their views, their ideas. And then once we have that, then you can possibly mute your phone back. I'm guessing that should work for everybody. Just another thing as well is that I kind of saw the list of participants, and we have mix of participants from industry. I saw a few people from the banking industry, a couple of guys from rating agencies. I saw a couple of people who are actually working on as finance consultants. I also saw a lot of students. So it's a mix participant list that we have. So what I would do possibly is keep it at a very simple / basic level, and we can then possibly take it from there. So I'm just going to start sharing my screen, and then we can start with the session. So Forum, can you just confirm if my screen is visible?
Yes, sir.
Yes, it is. Yeah.
Okay, great. Thank you so much.
Yes, sir.
All right. So let's start with this. So what I really want to cover is how to analyze banks / financial institutions from a credit standpoint. But I would just kind of like to give a overview of what types of financial institutions are there. So this is where we actually begin. So you can broadly divide financial institutions as banks, and that's where we are going to spend a lot of our discussion time. But apart from banks, I also want the audience to have a perspective of what are the other types of financial institutions. So this is the way I would categorize financial institutions as. You obviously have on top of the list the banks, and we'll talk a lot more about it. What are financial institutions? So there are essentially three types of financial institutions which I've kind of categorized. One is the developmental financial institutions. Then you have multilateral agencies, and you have specialized institutions. Now, what are development financial institutions? So I'm presuming a lot of you guys would have heard about the likes of, say, ICICI Limited or IDBI Limited or IFCI. Now, a lot of countries, especially countries like India, which are emerging markets, what governments have done is that there are obviously banks in the country, but they also established development financial institutions largely to support growth and largely to provide credit, essentially project finance, working capital to SMEs, MSMEs, and large corporates to either establish new plants, which is kind of called greenfield expansion, or you kind of increase their existing capacity, which is essentially brownfield expansion. So like a lot of other countries, India also had its share of DFIs. As I mentioned, ICICI Limited, IDBI Limited, and IFCI, these are pretty prominent DFIs which were established, I think, in the early 80s, if I remember correctly. Now, what has happened is that in India, ICICI has actually got reverse merged into ICICI Bank. That I think happened way back in maybe 2002 or 2003, if I remember correctly. And I think that was followed by IDBI Limited as well, which got reverse merged into the bank. So both these institutions don't exist anymore. But I know a lot of other countries, from my experience working in my previous organizations, where there are DFIs, in both in Asia, EMEA, and even in Latin America, where these institutions exist, and their prime role is to ensure, funding is available at the right time to, as I mentioned, SMEs and large corporates. Then we'll talk about multilateral agencies. What are multilateral agencies? So you guys would have heard, the likes of IFC Washington, or KfW Germany, or ADB, which is Asia Development Bank, which is headquartered in Manila, or for that matter, even World Bank. These are essentially multilateral agencies. Now, a lot of these agencies have dual mandates, wherein, like for example, ADB, or even the newly created NDB, which is called the National Development Bank, I think, which is headquartered in Shanghai. And I remember, I think KV Kamath was heading it in the initial first 5 years or so. Now, these multilateral agencies have one mandate to kind of focus on lending to either specific countries or geographies. Two, mandate to lend to a specific type of client base. Now that could be either corporates or financial institutions, or even onward lending. So that depends on the mandate of these multilateral agencies. The third type of financial institutions are actually specialized institutions. Like, say, I can talk about an example in India, which you guys can relate to, which is SIDBI, which is the Small Industries Development Bank of India, or NHB, which is the National Housing Bank. Now, these institutions are essentially focused on, lending to those specialized businesses. SIDBI, for that matter, focuses on lending to small industries. NHB is essentially, provides on lending, which is providing lending to housing finance companies or even banks for their housing finance portfolio. Now, that's what I pretty much wanted to cover in financial institutions. Then we can possibly talk about NBFCs. So there's a difference between financial institutions and NBFCs, and that is largely to do with regulation, where financial institutions to a large extent are regulated by RBI. NBFCs are also regulated by RBI, but the criteria for regulations of NBFCs is different from financial institutions. Now, what are the types of NBFCs that we will talk about here? So first we can talk about mortgage or housing finance companies. So I'm presuming a lot of you guys would know about housing finance companies. In the international market, some of these are actually called as mortgages, or actually mortgage finance companies. These entities are, I can give examples in India, which you'll have like HDFC Limited. You will have LIC Housing Finance. There are a lot of other similar housing finance companies as well. Now, the primary focus of these mortgage or housing finance companies, if maybe I can give a couple of examples for the US market, where in the US, we have the Fannie Mae and the Freddie Mac, who are actually the mortgage finance companies, and they have large, very large size balance sheets. Now, what do these mortgage or housing finance companies do? I think the first and foremost objective of housing finance companies is to provide home loans or mortgages to individual borrowers. And these kind of companies exist, as I mentioned, across the globe. In fact, because given my experience working in international firms, I can tell you that, say for example, a country like Korea, half the portfolio, or even that for that matter, Australia, half the portfolio of banks and NBFCs, or non-bank financial institutions, as they call it, is actually to mortgage, is actually for the mortgage business. So in countries like Japan and Korea, it's actually higher. Even in the US, it's a very large proportion of their overall balance sheet. In India, I know it's increasing, it's significantly large, but it's obviously not as large as some of the markets I mentioned. The second thing which the mortgage or housing finance companies do is to lend to real estate companies. Like some of them do, some of them don't, but I know that a lot of the Indian companies do. So, for example, if you have, say a real estate company like a DLF or Oberoi or Kalpataru or any other listed player, these companies would actually want to borrow money, and some of these housing finance companies have lending to these real estate developers. Now, a couple of things which I would want to highlight here is that between the two, and I think the third thing which I can also possibly add is that a lot of the entities, they also lend to the third player, which is called as a commercial real estate player. Now, the commercial real estate player is slightly different from the residential or the real estate developers. The real estate developer would actually want funding. So the way the real estate developer would go about doing the business is that they would have an identified land bank, either it's purchased or they have a plan to purchase that land, or a parcel of land. Now, typically, like some of them actually source funding for purchasing that piece of land. Some of them actually purchase that land based on their own funding. So that's where they can actually use the funding from NBFCs. The next step for them would be to actually, if it's a known developer, then usually they would actually open up their project for investors. There are some people or investors would actually want to invest, at the stage when the property is under development. There are some investors who would actually prefer only fully developed projects, and I'm actually the one who belongs to the latter. Having spent so much time in credit risk, I would actually want to give money and ensure that I can see my flat or property and then just buy directly. But there are a lot of individuals, investors who actually invest in the property at the development stage. There's an advantage is that you can actually get the property at a relatively lower rate than you were to if you were to buy it when the project is complete and when the OC is there. But at the same time, the investor or the individual property buyer is taking the risk that the project will get completed. For any reason, if there's a delay in the completion of the project, or for various reasons, if the project doesn't get completed, then the individual or the investor or the borrower would have actually paid at least a reasonable amount of money, and then he or she would have to kind of obviously face challenges or issues. So from a real estate developer perspective, if they have a land bank and they've opened the property for development, they'll get money from the investors or the individual property buyers. If not, then they would possibly again need funding, and that's where the housing finance companies would come in. Now, moving on to the third type, which is the commercial real estate developers, or I would say commercial real estate operators. So a lot of these guys are actually, that's a huge business in the US. And other development markets like Japan, I can say, UK, uh, Germany, Australia for that matter, Sydney. Now I think what they do is they will have a commercial property or a commercial building or a commercial park. They will
पढ़ लो बे
actually
दोनों ओए दोनों
they will have to then it's usually a developed property, and they will have very good infrastructure. What they will do is that they will lease out this property to companies or largely companies, but also small firms for using that office space. They also are into warehouses. They are also into factory premises. But I think a large proportion of their business would essentially be office space / warehouses. Now the way it works is that the entire development / operation of the property is with the commercial real estate player. The person or the company which is actually taking it on rent will have to pay monthly rent, which is actually negotiated based on their contracts, and the contracts would usually be annual. And then they would actually use that property. So a lot of companies, especially listed companies and large corporates, they don't own a lot of these properties. So for example, it's a bank. Apart from their headquarters, if it's a branch, they would usually lease out a branch, or if they have a back office operations team, which is sitting out of a different location, they would usually lease those premises. Now, that's where the commercial real estate players will get their customers. And from a housing finance company's perspective, they will actually be, uh, lending kind of, money to these commercial real estate players at various stages of their business. So they would be involved, at the time when the commercial real estate player is developing their property. They will also be involved in terms of, uh, you know, discounting their lease rentals, for example. So it could be various types of models that they would want to get into. So that's about the mortgage / housing finance companies. The next type which I want to talk about is the asset financing companies. Now these are again non-bank financial companies, or NBFCs as we call in India. They're actually focused on either one, two, or three, or a segment of products. Like for example, you will have companies like say Manappuram or Muthoot Finance, which are very large players in the gold financing business. Then you would have a lot of players who actually focus on providing consumer finance. So for example, G as a NBFC, which focuses on the consumer finance business in India. Then there are also smaller players, who actually focus on providing financing for white goods. Now, when I say white goods, it's essentially uh, consumer durables. So you have the likes of, if somebody wants to buy an air conditioner or a television or
Hello, audio not clear, please. Hello, audio is not clear, please.
Hello, sir. मेहुल जी किधर गए? Hi, can someone from the organizing team confirm on the chat box it has actually been postponed or not? So we'll just leave in that case. Thank you.
Okay, I'm sorry. There was a technical issue. I got my phone got disconnected. Can you guys hear me?
Yes, we can. Yeah.
Okay, great. Thank you. Okay, great. Thank you so much. Let me just quickly look at the chats. Okay, so there's nothing on the chat. So very quickly, can we, before I move on, can I just quickly talk about, and maybe we can just open the floor for a few minutes and then I'll get back. So can you guys tell me what are the types of banks? So now we are really going to talk about, what is bank and how do we kind of focus on the credit analysis of banks. But you guys can maybe unmute and tell me what are the banks that you've heard about, what are the things that you know about the types of banks. Okay, so in that case, since there was a silence, let me just quickly go back to my.
Join, I guess.
Maybe I will start. Yeah. Deepak here.
Sure, please go ahead, Deepak.
Obviously, so the most prominent which we see is commercial banks, right?
Yeah.
Well, that is one, and you have a small finance bank which they have recently started, and you have the central bank like RBI, which also kind of a monitoring thing.
Correct.
Regional rural bank (RRBs), they have a specific mandate. Cooperative bank, obviously their mandate is also different. So these are the banks I think which we have seen and which we experience on a day-to-day basis.
Sure, that was great, Deepak. I mean, you did cover quite a few things which I will talk about in the next slide. So, and thanks, Deepak. That was very helpful. I'm just going to open up my deck so that you guys can see. And yeah, so as Deepak mentioned, so I think broadly we can categorize the banks into 3 or 4 categories. And I've looked at one is the business model, the second is the ownership, and the third is the regulation. That's the way I would categorize banks broadly as. Now, the first is the wholesale / investment banks. So what do wholesale or investment banks do? These are essentially banks which focus on large corporates or financial institutions. They also do business with mid-sized corporates and small corporates, but they would typically not do business, or they would not do retail or consumer loans. Then I'm sure everybody knows what are investment banks. They are also essentially wholesale banks who focus on large corporates or mid corporates or small corporates. There are also investment banks who actually deal with small entities, but from the way I see, it's largely wholesale or corporate focused. Now, so just to give an example, Morgan Stanley is an investment bank. Then you have Goldman Sachs, which is an investment bank. You also have a lot of the entities in India which have investment bank divisions. Some of them have separate entities. Some of them do it within the. Some of them actually do it within the securities business. Some of them actually do it within the banking business. Now, moving on, what are retail / consumer banks? As the name suggests, they would do retail business both on the asset side as well as the liability side. They are focused largely on doing mortgages, as we spoke about earlier, or housing finance. They will also do auto loans, or two-wheelers, four-wheelers, commercial vehicles. They will also do credit cards. They will also do personal loans. They will also do other loans like loan against property, then gold loans, etc. So it depends. It depends on which areas some of these banks have expertise. Like as I mentioned, some of these NBFIs, they could actually be focusing on 2 or 3 products, but most consumer banks will have a the entire bouquet of products they'll offer to their customers. On the liability side, they will do typically savings and demand deposits. Sorry, savings and term deposits. Demand deposits will essentially be current accounts, which they will do with their corporate or smaller kind of corporates. Now, what are commercial banks? So in India, banks are typically known as commercial banks, and they do both of the above. They do the wholesale or the large corporates business. They also do the retail and the consumer business. So, their mandate is largely to accept deposits from depositors and lend to borrowers, both on the retail as well as the corporate side. Now, universal banks. So that's a concept which is largely predominant in the West, but we can also call some of our commercial banks as universal banks. By definition, it means that they offer all the products, right from corporate lending, investment banking, M&A advisory, corporate finance, working capital, term loans, derivative facilities. They will offer consumer lending to the set of consumer borrowers. They will offer cash management products. They will offer trade finance. So they will offer foreign exchange, rates. They will offer securitization products. So they will offer the entire gamut of financial services to their customers. That's why they're called universal banks. So I know a couple of banks in India which are typically, they do literally 90-95% of what a universal bank in the US would do. Then nowadays, you're also see a lot of these payments bank which has come in. So you have a Paytm Payments Bank, you have the other one. Okay, I'm not getting the name. I have to look at my apps. You have the Airtel Payments Bank. Then their focus is essentially on ensuring that, I think the first and foremost experience is what is their focus. For example, if a customer is conducting a business online, they want to ensure that the payment process gets done at the click of a button. So that's where some of these banks have actually made huge inroads, especially with the last, I would say, last 5 years. First, after demonetization in India in 2016, and then after the March 2020 lockdown, when everything virtually went online. So that's where your payments bank come in. The second is the savings bank. Now, we do have some of these in India as well. Like, for example, the post office is actually a savings bank in India, where you can actually open a current account or savings account there. You can open deposits. You can actually have a national savings certificate. So these are essentially savings banks, but they don't do lending. There are savings banks across the globe in a lot of countries, and their primary target is to accumulate savings from retail customers. The second way to kind of categorize banks is based on ownership. As I mentioned earlier, public sector is state-owned or government-owned. Private sector is essentially privately owned, obviously. Again, it depends from a country to country as to what is the ownership model. Like, some countries have all the banks which are owned completely in the private sector. Like, I can give you an example of Australia, where there are 4 large banks in Australia, and all of them are actually privately owned. Then if you talk about India, I mean, you have a mix of both. You have public sector banks and private sector banks. State Bank of India, which is the largest bank in India, is obviously still majority owned by the government. You have State Bank of India is listed. You have investors, both institutional and retail, who are actually shareholders in State Bank, but the government still owns the majority stake in the State Bank of India. And third, the way I would categorize is actually based on regulations. So you have scheduled commercial banks in India. Then you have cooperative banks in India. So all the see the likes of State Bank, ICICI, HDFC, yes, Kotak, Canara, they are all or Union Bank, they're all scheduled commercial banks, and they're obviously regulated by RBI. And then you have cooperative banks. You have your state cooperative banks. At the state level, you have district cooperative banks at the district level. And then you have rural/urban cooperative banks. So these banks are, different types of banks have different regulations. But most of the cooperative banks in India are governed by NABARD, which is the regulator for cooperative banks, and they'll have to follow the regulations of NABARD. Now, that's a kind of quick overview on banks. We will now move on to see why do we need to analyze and rate banks. So does anybody want to just take a quick shot on why do we need to analyze? So we all do a lot of analysis on corporate sector. We look at Reliance, we look at Infosys, we look at various companies, both from a capital as an equity market perspective and debt market perspective. But why is the need to analyze and rate banks? Maybe I'll just pause for a few seconds, and if anybody wants to just talk about the need, then we can get participation from the audience.
Good evening, sir.
Hello, good evening.
Sir, my name is Balpreet Singh, and I would like to answer this question, sir.
Oh, please go ahead, Balpreet.
Sometimes when bank required to raise funds, in that situation, they issue bonds, and at that time, their rating helps the customer to decide the credit risk that is associated with the bank. Or sometime while when the bank issue LCs to on the behalf of the importers, at that time the foreign bank who is to receive the payment see that the what is the credit rating what is the credit rating of the bank who's issuing a guarantee that if the importer is failing to pay the money, then the bank will be paying.
Sure. I think you did speak about quite a few good things, Balpreet. So thank you for sharing your thoughts.
Sir, I
So
would like to add something.
Sure, please go ahead. Who's this?
This is Karthik. Hi,
Hey,
sir.
Karthik,
How are
please
you?
go ahead. Good, I'm good.
How are you?
Please go ahead.
So, sir, I would say like banks are basically rated so that to make sure the soundness of the bank itself is intact. Like they are acting as the middlemen where they're taking money from the public and distributing to the corporates in the form of loans or non-fund based facilities that as rightly discussed by the previous speaker, Balpreet. So just to make sure that yes, they have the right financial knowledge to make sure that these assessments are correctly made, and by the end of the day, there's no credit risk on the entire country itself, because there is this responsibility that has been given to the bank. So it's more like a health checkup that yes, the body that has actually been appointed to delegate such a task is in their right soundness.
Sure. I think that's correct as well. So I think all of you guys did touch upon quite a few aspects, and they are all relevant. So I'll tell you what, now maybe there are two ways in which credit rating is done. One is, say for example, it's ICICI Bank or a State Bank of India or a Goldman Sachs or a Morgan Stanley. They do get themselves rated with a credit rating agencies. That's one part, and as I think it was Balpreet who highlighted that. So I'm not sure who, but yeah, if one of the three of you all did highlight that, if you want to raise funds, the rating helps in terms of getting a good pricing. It also helps to attract investors in the market. It also helps to ensure that the investors know what is the risk on the bank. So that is the case when the bank or the financial institution it's actually getting itself rated. Okay. Now, there is also a second situation where banks or financial institutions are rated by the counterparties. Now, what do I mean? Say, for example, let me just take a bank in Singapore. Okay. Now, Development Bank of Singapore is one of the top 3 banks in Singapore. It does business with say a bank in Australia, say CBA, which is the Commonwealth Bank of Australia. Now, it's likely that CBA has a rating, which is an external rating. It is likely that CBA doesn't have a rating. But for a DBS in Singapore, it will do business with CBA only after it is able to understand the risk with CBA or to understand the quality of CBA. So the point I'm trying to make is that every bank will do business with another bank or another counterparty. And from that perspective, it becomes very important for that bank to understand the risk of the other counterparty, to understand the key strengths of the counterparty, to understand the key areas of concern of the counterparty, and make sure that the exposure that they are taking with the counterparty or the business that they are doing with the counterparty is in line with the model or the appetite of, or their own, is in line with their own risk or their own model. So let's just go back to the next slide and see what we are talking about here. Say, for example, so in fact, let's just continue with the example I mentioned. I mean, a DBS is wanting to do business with CBA in Australia. So DBS will have counterparty credit limits with the they will have counterparty credit limits for CBA, which means that it will be willing to do, say, for example, $100 million worth, or say $500 million worth of business with CBA. So at any given point in time, a DBS exposure, or I would say rather the other way around, CBA's exposure to DBS in the books of DBS cannot exceed $500 million. So that's why DBS will try and analyze the business of CBA, and then they will try to come up with an internal rating. Now, similar to an external rating, the internal rating is also used for exposure. Like, for example, for an external rating, it will be on the bond, as one of you guys mentioned. So say, for example, if it's a 1 billion bond, then that rating is for that 1 billion bond. Similarly, in case of an internal rating, it's say a 500 million exposure. So it will be used for the 500 million exposure.
The screen is not visible, sir.
Oh, is it not visible? Can I just, one second, let me just share, please. So what has happened is that I think forum has left and I can't share it because it's not allowing me to share. It says only the host can share in this meeting. Oh, okay. So I'm sorry, guys, I can't, I'm not able to share my screen. But let's do one thing. I mean, whatever I'm going to talk about, it's can you just give me a second? I can just check with forum if she can just log in again and give me the right to share. Just give me 2 minutes, please.
Yes.
I think
It's visible, sir, now.
okay, perfect, great. So we'll just go through slide. Apologies for this technical issue. One second, let me just pull out my deck. Okay, here we are. Okay, so why do we analyze and rate banks? So we spoke about external ratings, I think, which you guys did cover well. Now internally as well, in terms of why a bank will rate other counterparties, largely from first, know your customer / client requirement. Then second is it helps in terms of setting up counterparty credit limits. The third, as I mentioned, is for exposure. Now, the pricing is also dependent on the credit rating. For example, if a counterparty bank is rated or has a higher rating, then the pricing will be finer. And when I say finer, it means it'll be lower. So the counterparty will actually get a benefit of. And the last thing is the capital charge calculations. So I won't get into too much of technical details, but the counterparty's credit rating is actually used to calculate the capital charge so that, and this actually goes into the capital adequacy calculations for the bank. So, I will just kind of make it a little simple. If a counterparty has a very high rating, say for example, in case of a DBS, if they rate CBA, which is Commonwealth Bank of Australia, as say AA plus, then the capital charge on CBA for DBS, or rather in the books of DBS, will actually be lower than another bank which they could have possibly at a say BBB plus or a single A minus. Okay, so that's what capital charge is. Now, so that's the internal part of it. Now the second part of it, which is the external rating, I think you guys did cover it, and I'll just quickly run through it. So what is credit rating? See, credit rating is simply an assessment which a rating agency does, or in our case, we'll also talk about internal ratings which a bank would do to assess the ability and the willingness of the borrower. It's a very simple assessment of the ability and the willingness of the borrower to meet its financial obligation on time. In simple words, it's the ability of the borrower to repay its interest and principal on time. Okay. Now, what is broadly, how do you arrive at a credit rating? I think broadly, most rating agencies and most banks follow a very simple model. Okay, it's obviously a complicated model, but I have worked on it for a long time, so it looks a little simple to me right now. But the first and foremost step is to analyze and assess the probability of default. So the probability of default essentially says that for this particular counterparty, what is the likelihood of the counterparty defaulting in the near term, or the next 12 to 18 months. Typically, it's a 12 to 18 month short / medium term view. So that is called the PD, or the probability of default. Now, the second aspect to that is a loss given default, which is LGD. So, say if a counterparty defaults, then what will happen to the losses? Say for example, when a counterparty defaults and the asset size is $100 billion, and based on and a counterparty would have defaulted only because it had issues in terms of running its operation smoothly. So which technically means that its liabilities are actually more than its assets. So if the bank or the counterparty is only able to recover, say 60% of its assets, in which case there is a loss of 40%. So it means that of 100 rupee worth of assets or 100 billion worth of assets, the counterparty is able to recover only 60 and 40 is the loss, which would have been to be borne by different creditors as well as equity shareholders in various order. And that's a separate topic altogether. Then the third thing is exposure at default. So that is basically my exposure to the counterparty at default. So for example, if the counterparty's balance sheet is $100 million, but my exposure at the time of default is only, say, for example, $6 billion. So my exposure at default is only restricted to $6 billion. I know that the LGD is 40%. So assuming that I am senior to the other creditors, or I am at par or pari passu to the other senior creditors, that my expected credit loss is 40% of 6 million, which is $2.4 million. So that's how, those are the things that a credit rating agency would also look at, and those are the things which banks also look at when they are looking at counterparty credit ratings. Now, very quickly, there are three types of credit ratings. One is the issuer rating. So this I'm talking about largely from a external rating perspective. So in India, there are three large agencies. You have your CRISIL, you have ICRA, and you have CARE ratings. There are also a couple of other ratings agencies which have come up, like you have Brickwork, you have Infomerics, etc. Globally, there are three recognized rating agencies. You have S&P or the Standard & Poor's, you have Moody's, and then you have Fitch. Now, when you look at an issuer rating, it is a rating which is assigned by a rating agency, or even a bank in our case.
Hello.
where can everybody please have their phones on mute, please?
Sir, I just logged out because the class was suspended. I just wanted to know when did we restart, because I again logged in now.
So actually, I had got logged out. There was some connectivity issue, but maybe it took me just about 3 minutes or so to log in back.
Okay, thank you, sir.
Sure, thank you. So issue rating is a rating. It's basically a rating of the entity. Like for example, if Fitch does a rating of Reliance, or if S&P does a rating of State Bank of India, or if Moody's does a rating of Deutsche Bank, then this is actually an issuer rating, irrespective of the issue or the facility. So it doesn't talk about senior credit, secured credit, or unsecured credit, or subordinate credit. It doesn't talk about. It's just a plain issuer rating of the entity. The issuer facility rating, obviously, it's the rating on the specific facility or the specific issue. Say for example, if we just said that they're going to come up with a 1 billion bond, and if Fitch or a Moody's or a CRISIL or a CARE is doing a rating of those bonds, then it's very specific to that issue, and it's not a generic rating, and hence it's called an issue rating. Now, typically, the issuer rating and the issuer rating are within 1 or 2 notches of each other, but there will be a differential to the extent of a notch or 2, and that's largely to do with the seniority of the creditor, of that counterparty. So let me just take an example and talk about it. Say for example, Bank of America. It will have debt at various levels of its capital structure. At the topmost, it will have secured debt. At the next level, it will possibly have senior debt. At the third level, it will possibly have unsecured debt. Then it will have subordinated debt. So the secured debt, which will actually be senior in terms of rating or in terms of what I call the default, cash flow waterfall mechanism. So if a Bank of America, for example, were to default, then the secured creditors will get their money first. Then you will have the senior creditors who will be in the queue. After that, you will be have unsecured creditors, and then you will have subordinated creditors. So the higher you are in the capital structure, and the more secure your debt is, the better the issue rating will be. Okay. Now, the last thing which I will talk about is the standalone rating. So the standalone rating is essentially issued by rating agencies. That is the rating which is assigned to a counterparty without factoring in any support. Like, you can have ownership support or you can have government or regulatory support. Now, standalone rating is essentially the rating which is assigned based on the standalone financial strength of the entity. It doesn't factor in any ownership support or government or regulatory support. Just to give you an example, let me just think about something which you guys can relate to. So, for example, let's talk about Yes Bank. We all know that there was an issue with Yes Bank, I think in the first quarter of 2020. And, obviously there was a government intervention. So, they actually, there was a lot of things which the government did, but I don't want to get into the details of those because that will take a session by itself. But, government did a lot of things where there was a freeze on the outflow from Yes Bank. There was a freeze on what the customers could withdraw. There was a change in the management, etc. So this is called regulatory intervention or regulatory support, so to speak. Now, it's a private sector bank where the government intervened and support was provided. So that may or may not be true in case of all private sector banks. But there's a reasonable belief in India that the state-owned or the public sector banks would be supported by the government of India or RBI. So that's when rating agencies or banks actually factor in support, or I would say plausible support from the government if there is sufficient reason to believe that there would be support provided if the need arises. So guys, it's actually 6:27 in my watch. This room where I am is actually freezing, and I'm freezing despite my jacket. So just have to give me 3 to 4 minutes. The admin person is right outside. I have to swipe my cards a couple of times. I will be back by about 6:30, and the max is by 6:32. So just give me like 3 to 5 minutes at the max, and I'll be back. Apologies for this. If I continue here, I'm going to just fall ill, and I don't want to do that given the environment outside. So apologies. I'll be back in 3 to 5 minutes. Hi, I am back. So let me just check if everybody can. So can you guys hear me?
Yes, we can. Yeah.
Yeah, I'm sorry for this. This is now much more bearable. Okay, great. So I think we just spoke about quickly credit ratings. Essentially two parts to it. One is external credit rating agencies. So you have the likes of Fitch, Moody's, and S&P, and then a lot of banks also do it internally.
Again, not visible, sir.
Or not visible, is it? Hang on. Yep, I think we're there. Thanks for highlighting. Yeah, here we are. Okay. Now we'll move on in terms of, what do we do when we look at banks? Okay. So, there's a very simple framework which is followed mostly across rating agencies or across, the banking space. And I've kind of modified that. I mean, it used to earlier be called CAMEL, but this is the way I actually like it. So it's called CRAMELS framework, which is the C stands for capital adequacy, the R stands for resource raising ability, the A stands for asset quality, the M stands for management quality, the E stands for earnings analysis, the L stands for liquidity funding, and the S stands for systems and technology. So this is something which personally I use it, and I used to obviously talk about it when I should do trainings at my previous organizations. But this kind of broadly captures everything that you should look at from a standalone rating perspective. And again, we are not talking about the ownership / regulatory support here. So I obviously looked at rating agencies like Fitch, S&P, Moody's, CRAMELS. I know what their criteria are, and if you look at all these parameters, it broadly sums up everything that we should look at when you want to try and analyze a bank or a financial institutions. So we will go and talk about each of these over the next maybe 25 odd minutes today, and then we'll continue talking about it on Friday as well between 5 to 7. This acronym or this framework is called CRAMELS, but it's not necessary that we are going to use it or look at it in this particular order. The idea is that, one, this is easy to remember, CRAMELS. Two, the second is that all of these things should have been looked at, before you arrive at a tentative or a suggested rating for a bank. So let's move on. And, we are going to spend a lot of time talking about each of these. In fact, maybe I'll try to cover a couple of these points today, maybe 2 or 3, and then we'll do the balance 4 or 5, on Friday when we speak again. So I've just kind of taken a screenshot of what a balance sheet of a bank looks like. Okay. Now, this is what I got. I mean, this is like I'm going to give courtesy of this to Google because I have not prepared this. It is sourced from Google. So this is just the State Bank of India. It's a little dated, but it will give you a good perspective of what the line items are. So it's very important to understand that a bank's balance sheet is quite different from the balance sheet of a corporate. Okay. And I mean, I think one of the things which I keep talking about is that, a lot of you guys who are either professionals or students, you guys get exposed to, balance sheets of a corporate or a company. But, we never get exposed, at least in my days, when I was studying my MBA, I don't think I got exposure to looking at a bank. But I think nowadays people, and I'm talking about, more than a decade, more than 2 decades ago. So, there's absolutely no internet at that point in time. There's a Rediff mail, if anybody knows what it is. And Hotmail was just just catching on. But nowadays, I think there's access to information, at the click of a button, and I'm sure a lot of people are aware. Now, the key important points to understand is a corporate is in the business of, let's take a case of a large corporate. It will take, say, for example, if it takes loan from a bank to set up a plant, say it's a large corporate setting up a cement plant. It'll take loan from a bank, set up a cement plant, operate the plant, sell, buy raw materials, consumables, manufacture cement, sell it to customers, recover money from the customers and pay to the suppliers. While doing all this, the banks will also have fixed costs like salaries. It also have wages. It also have to pay electricity. It will also have to pay interest on the loan that it took from the bank. After doing all this, whatever is available as surplus will go back to the shareholders. Now that's just a simple example of a corporate who is into manufacturing or cement. Now, what is the business of a bank? The bank's primary business is to accept deposits from depositors and lend money to interested borrowers. While doing this, the banks will also have employees. The banks will also have fixed costs. The banks will also have overheads. The difference here is that the loan which a bank will give to a corporate or even to another counterparty bank is an asset, whereas a loan which a corporate takes from a bank is a liability, and rightly so. So when you are borrowing from a bank, it is your liability to pay back that money to the bank on time. And when the bank is lending a money to the corporate, it is an asset of the bank because the bank has the right to recover that money or to recover the interest on that loan and the principal outstanding at predetermined intervals. So the most important aspect is that the loan, which is for a corporate or a company or an individual, is a liability, will actually become an asset for a bank. And that's why it constitutes one of the largest constituent of a bank's balance sheet. What are the other line items which a bank will have? Let's talk about the asset side first. So the bank will obviously have cash because the bank will have to keep cash at its branches. They will have cash in the currency chest. They will also keep cash with RBI. They will also have accounts with other banks. They will also have accounts with the RBI or the regulator or the state or the central bank. So cash and balances with RBI, balances with banks and money at call. These are the two items to begin with, and these are essentially liquid. Now, why do banks keep cash? Because, like, for example, I have a savings account with, say, an ICICI bank. If I want to go and withdraw money, I can go to the branch and withdraw money. I can go to the ATM and withdraw money. I can do an online transfer. So for withdrawing cash money, I will have to go to the branch or an ATM. And hence, they will have to keep sufficient money both at the ATMs as well as at the branches. Now, advances. What are advances? They are essentially loans lent out to customers. They are either individual customers or corporates or even counterparty banks. So that will constitute. So if you look at the size, out of 566, I'm presuming this is lakh crores. State Bank of India. Yeah, I'm presuming this is 566 lakh crores. About 337 lakh crores is roughly advances. So about what? More than 50%. In fact, it's very close to 60% of the bank's balance sheet is actually loans and advances. Then the banks also have another line item called investments. So banks by regulations, like for example in India, there's a regulation called CRR, which is 4%. There's a regulation called SLR, which is 18% right now. So banks are required to keep a portion of their demand and time liabilities, and we'll come to that in a while. But for the time being, they are required to keep aside a portion of their liabilities in specified securities, be it CRR, be it SLR, and that is what constitutes a large proportion of the investments. Now, investments will typically include investments in government securities, or GSEC as they are popularly known in the market. Then they will also have investments in bonds or debentures issued by either other corporates or other banks or other financial institutions, which investments as a whole constitute again another large chunk. So if you add up 150 and 337, that's like 587. Is that true? Yeah, roughly. So it pretty much makes up the entire balance sheet. There's nothing which is significant. So when you're looking at the bank's balance sheet on the asset side, there are two main items: loans and advances, and then investments. And those are the ones where you really focus on, spending your analytical time. There's also another item, which I want to talk about, which is the intangibles, and we don't see it here, or maybe it's there in other assets, but we'll have to go and look at Schedule 11. I don't know as of now, but that's also one area which you really want to spend some time thinking about, and I'll explain when we talk about net worth as to why that is important. On the liability side, I think one of the most important thing for the bank will be deposits. So that's the money that they owe to the deposit holders, both savings account holders, current account holders, and term or fixed deposit holders. So you can see out of the balance sheet size of 566, roughly 435 is actually deposits. So which is very close to 70% of their total assets or liabilities is in deposits. The banks also have borrowings. So borrowings is essentially borrowings from other banks, other financial institutions, from the government or the central bank or the regulator. So that will be, clubbed under borrowings. If the bank has issued any bonds, that will also be classified as borrowings. So that again constitutes another 40 lakh crore maybe. So that's 475, which is the largest. So that's called total debt, which is 475. The other, obviously, the important aspect of the bank's liability side is the net worth, which is essentially the shareholders' funds. So there are three important items which I would say. One is your share capital. The other is your reserves and surplus. The third is your share premium. Now, these are all essentially the money contributed by the equity shareholders towards establishing and running the bank. So if you see, it's very close to 31 lakh crore. So I don't know if it's, maybe I'm getting the numbers, I'm not sure. Is in rupees crores. So my sense is this could be 56 lakh crores and not 566 lakh crore. So that'll be too huge for State Bank of India. I think it'll be about 56 lakh crore or maybe 5,66,000 crore. I'm not sure. I'll have to get that. But the point is, the share capital still constitutes very close to. So if you look at 31 out of 566, that's still about 7%. A little more, a little less than 7%. That's a large number again. So this is a quick synopsis of State Bank of India. One of the things I would suggest is if any of you are genuinely interested, we will cover a lot of the things in the next session on Friday between 5 to 7. What I would suggest is between today and Friday, look at any bank's balance sheet. It's very easily available on their website, usually under the investor section. Just look at the annual report. Look at just glance through it. It'll take about a couple of hours if you really go through it in detail, but it will give you a good perspective of what you're going to cover now and even on Friday. So it's up to you. If you are interested, I can suggest anything. You just look at ICICI, State Bank, HDFC, Axis, whatever suits you. If you look at an Indian bank. Now we will move on to the income statement, just to give you a quick, understanding or overview of what an income statement looks like. So continuing with our example, what would the corporate have done? The corporate would have sold goods, sold cement. They would have collected money from, customers. They would have paid salaries. They would have paid wages, and they would have then, made their income statement. Now, a corporate income statement is very different from that of a financial institution or a bank. So if you look at a corporate's income statement, it starts with revenues. Then you have COGS, which is cost of goods sold. Then you get gross profit. From there, you deduct SG&A, which is selling, general and administrative expenses. Then you get your EBITDA. That's how we look at it from an analysis perspective. Then you look at your depreciation and amortization. Then you look at, after that, you get your EBIT. If you deduct interest from that, you get EBT, which is earnings before tax or profit before tax. You deduct tax and you get your profit after tax. So that is for a corporate. Typically how you do it from an analysis perspective. So different countries, different companies will give you income statement based on how it is done, required to be done in a regulatory way. But what I described to you just now, a corporate income statement, is largely the agreed and accepted norm followed across banks, financial institutions when you are looking at a corporate entity. Now let's look at a bank's income statement. This is a sample. I think it was of CBA is what I recollect. Then I'm not very sure. Again, I'm going to give Google the courtesy. That's where I sourced it from. Okay, now instead of revenues, the bank will have interest income and interest expense. And that's what you go, and that's after that you get your NII, which is your net interest income. So your net NII or your net interest income, after that you add, what you call other banking income, which will essentially be your fee income. And then you add funds. So you get your net banking operating income. Then you are adding your funds management income, your investment revenue, claims. Now what I see here is that this essentially is for the group and the bank as well. I mean, that's what you could possibly see on my screen. Let me try and make it a little bigger so that it's visible. I think this is what is perfect. So if you look at the group, they have funds management income and investment revenue, but the columns towards the extreme right, which belong to the bank, they would not have any of those items, because typically a bank will not have these under its license, and most jurisdictions or most countries now require the insurance entity or the asset management entity to be under the group or the bank holding company and not under the bank. So typically in case of a bank, if they have a pure banking license, then these entities will not be under the banking legal entity. Okay, Okay, so let's just focus on the right, and we will not talk about the group because that's a little more complex. So your net bank operating income, which is the fifth row from the top, and 17,775 and 19,774, that's equivalent to your gross profit for a corporate. Okay, now after that you deduct two major items. So I'm looking at the total net operating income before impairment and operating expenses. That's just around the middle of the slide, a little lower than the middle of the slide. So there are two main costs which a bank has. One is your operating cost and your loan impairment expenses. I want to remind you that the interest expense is already captured up. So your interest expense, my interest income minus your interest expense gives you your net interest income, after which you add your other banking income and you get your net banking operating income. So apart from the interest income, which is already captured at the top, there are two other items. One is your operating expense, that's your salary to the employees, rent of premises, electricity, legal charges, traveling, etc. The second other item is the loan impairment expenses. Now, this is something which we will talk about at length during the next 2 hours on Friday. But loan impairment expense is essentially your credit costs, or in India, they're called provisioning charges or provisions or loan loss provisions or provision costs. So just to give a very quick overview, every bank is required to set aside provisions to meet credit costs in the future. So those credit costs get and hit the income statement of the bank every year. Now, if you can possibly see that the 871 is negative and so is 1042. So this is actually a write back. Now, what does that mean is that they are provided much higher in the prior years and they've realized that they are not going to incur those kind of provision expenses, and hence from the provisions that they made in the prior years, they're actually writing back to the income statement. And is it that, or is it actually no? I'm sorry. I apologize. It's not that. All the negative items are actually in bracket. So it's actually a pure provision charge or expense in the current year, which is taken out of the profit. So I apologize. There's a confusion in my mind as to why it's a negative, but they are actually deducting everything which is an expense as negative. So it's a pure expense. It's a pure charge which they are incurring in the current year. Now, if you see in 2014, they have made a provision of 871, whereas in 2014 it was higher at 1042. So what you can possibly infer, just one of the inferences, is that either their asset quality is marginally improved, or they possibly provided little higher in the year, and they don't see as much provision required in the current year as last year. Now, then you have your corporate taxes. Is very simple. It's income tax, and then you have a net profit. So that's all I wanted to kind of just talk about the income statement and balance sheet. I think the important point here is to understand that it's different from that for a corporate. We discussed as to why it's different and how it's different on the balance sheet side, on the income statement side. On the cash flow side, I think one of the things which I want to really highlight is that when you analyze a corporate, the cash flow is a very important statement. In fact, a very good analyst, if you give him income statement or a balance sheet, he'll be able to figure out the cash flow. If you give him balance sheet and cash flow, he'll be able to figure out. And when I say give him at least the last 2 or 3 years, he'll be able to reconstruct a balance sheet. If you give him a balance sheet or in cash flow, he'll be able to deconstruct what you call as an income statement. But cash flow for a bank is very different. The fact is, everything for the bank is cash, and cash is the raw material. Or so if anybody is depositing money, it's cash. If anybody is withdrawing money, it's cash. If anybody is taking a loan, it's cash. Anybody is paying back the loan, it's cash. So cash, because of the fact that the bank is dealing in only cash, and that's essentially the raw material, unlike a cement company which will have soda ash, limestone, other requirements to manufacture cement. For a bank, the only thing which is the raw material is cash. So typically you don't focus so much on a cash flow for a bank, because it's not it doesn't really give you a lot of things which you want to look from a analysis perspective. So cash flow is not very, I would say not, I personally don't use the cash flow at all when you look at a bank, because it doesn't really give you any additional stuff that you would if you were to look at only the income statement, balance sheet, the notes to accounts. They become very important. So I see we have only a few minutes left. So maybe I will just open up the floor for questions. And in the next, I just wanted to kind of set the context and the ball rolling so that you get a top-down view of what you're going to look at in the next time. We will get a little more technical during the next session when we do it on Friday between 5 to 7. If you're genuinely interested, my suggestion would be just go through 1 or 2 annual reports. Even 1 would suffice. Go through the annual report, go through the income statement, balance sheet, the notes to accounts are very important. A lot of the banks nowadays have disclosure in the annual report itself, where it's a requirement from a regulatory perspective. It will just give a lot more information, and you'll be able to really appreciate and absorb what you're going to talk about in the next session. So I'm going to stop talking here. I'm going to open it to the floor. Feel free to ask me any question that you have. No worries. There's nothing like a wrong or a stupid question. So over to you guys.
Hi, sir. Karthik this side again. Hi.
Yeah, Karthik, tell me.
Sir, it's more like it's not exactly a question, but more of an opinion seeking from such an experienced person in the industry. I would say I would just like I just wanted to ask, like, considering the Evergrande's current situation,
Okay.
the entire company is falling down, and there are ripple effects in the economy. So, considering that India is also like planning for development phases where they're strengthening ties with cross-country borders with Australia, there's news with Taiwan, and there's news with UAE. So, considering all this, can you say that exactly, like, for taking an instance, like US has actually given out interviews or reports saying that the country is ready for Evergrande's ripple effect. So, can we say that India, being a developing country, surely should be ready for such a ripple effect, or should additional measures be taken so that such a situation entirely is not a point of concern for India itself?
Okay. So let me just first put a very upfront a caveat. This is my whatever I'm going to answer is going to be my personal view. It has got nothing to do with any of my organizations that I worked with so far, or what I'm doing currently as well. I just want to kind of put that on record. So as an analyst, see, I've gone through what's happening with Evergrande, and I've also attended a couple of rating agencies calls. S&P did one very nice call. I have also gone through quite a few material. There's a nice. There are a couple of good articles. One was done by, I think, WSJ, which is Wall Street Journal. The other, there's I think I remember having seen an economist article as well. So what I'm going to say is actually based on my reading and my understanding of the situation. So if you really think about it, Evergrande is actually it's quite a big event right now. There was a, if you look at the media, it was being called as the next Lehman event.
Yes, yes. Multiple analogies
yeah,
have been drawn
correct,
drawn
correct.
across. Yes, yes.
So and I'll tell you what the reason is, because of the scale of the issue or the scale of the problem, if we were to see it from that perspective. Now, uh, Evergrande is actually the largest real estate developer in China. I think it's, from what I recollect, it does about 1 million units every year. It is present in about 250 odd cities in China. It has got a huge amount of balance sheet, and it's got a huge amount of debt. So there are different institutions, different agencies, which are talking about different numbers. But I think everybody's kind of closely agreeing to the number, which is $300 billion roughly. Now, I'll tell you what, I'll give you my perspective. So I really couldn't, I really don't know what is the view of US, because that's something which I'm not sure how that will pan out. But I will give you my perspective on what could possibly happen. Okay, and give me a second. In fact, I had actually, made some of those points when I was attending that session with somebody else. Just 1 second.
Sure, sir.
Yeah. So in fact, yeah. See, I'll tell you, they have, I just kind of got my notes. They have debts, which is, local currency, as in, which is denominated in CNY, which is Chinese yuan or renminbi, as they call it. They also have, debt, which is to the local. So they have debt, which is to their, retail employees and customers. They have debt, which is to the financial institutions, which is like the banks, the insurance companies, the broker dealers in China. They also have local currency debt and bonds, which they have already issued. Okay. So, the way I see it, and based on my understanding of China as an economy, in fact, I've been tracking China way back from, is it 2006 onwards? So it's like 15 years. I've done like multiple stress tests, one as as my role in prior organizations, or out of curiosity, in the recent past. So what I feel will happen, and this again my personal view, is that there'll be some sort of intervention which will come from the regulator at some point in time. They will ensure that the debt to the customers and the employees will be met. There will be some sort of a compromise which will happen when, when I say compromise, they would possibly restructure the debt to the financial institutions. And when I say financial institutions, I'm talking about the local Chinese banks and institutions. In terms of in terms of the foreign currency debt, which they have to the international players, again, I'm strongly inclined to believe that that would also be restructured. Okay, but that could actually technically amount to a default. So I'm not really sure on that aspect as to how they would do it. But I have a very, I'm kind of inclined to believe that it will be managed with a government slash regulatory intervention. Personally, I don't see it blowing out beyond manageable levels. If it does, then it could there'll be a lot of ripple effects, uh, not just in China, not just in Asia, but across the world, because of the sheer scale and size of the entity.
Sir, here are we talking more about the offshore investors in the company? Just a preview.
Yeah, yeah. So you'll have
And
foreign and both. When I say offshore, I mean, for example, if they have, if I have not really got into the details of Evergrande's balance sheet, but what I mean, I'm just trying to kind of share my knowledge based on the calls and the readings I've had. I'm talking about investors which are based in the US, in Europe, or in other parts of Asia who've invested in foreign currency denominated debt of Evergrande, or even local currency. But I doubt if they would have taken local currency investments. So I'm talking about these kind of investors who are outside of China, and they are in any of these locations invested in Evergrande.
thank you, sir. So, sir, my
Hi,
entire
Mr.
point of
Mehul. Yeah.
sure, Anand, if I could just get a minute, I'm really sorry.
Sure, go ahead.
Sir, so here, like my point of asking the question was basically that with the introduced relaxed PSL reforms that the regulatory body has been coming up with, plus there are actual instances where India is looking forward to strengthening ties with multiple nations across. So, and the entire Evergrande situation happening along. So, can we see some regulatory, like additional reforms that the regulators might take so that such a situation could be prevented? Like
Oh,
we are
absolutely,
focusing on
absolutely,
growth, like we are actually
absolutely.
focusing on growth, but what kind of additional security measures can we look up to?
So I'll tell you what, I mean, I'm just going to draw the context of this Evergrande to the global financial crisis, which really started with the Lehman Brothers crisis, but uh, there's also one more event prior to that, which is the Bear Stearns acquisition of JP Morgan. Now, after every crisis, regulators become, I would say, they look at the event, they come up with what are the things which we can do to possibly tighten the screws, what are the things to do which we can what are the regulations which we need to come up with to make the system, I would say, more foolproof, or what are the things to ensure stability of the system. I think that's the most important objective. So if you look at the GFC, there are quite a few things which has happened. The first was the Dodd-Frank Act. The second was the Volcker. I mean, so Volcker rule is again the part of the Dodd-Frank Act. And I don't want to get into those regulations because it will, we're just already out of time. But at some point in time, if you guys are interested, I can talk about that as well. Then you had the Basel norms, which Basel 3, which incorporated things like LCR, which is the liquidity coverage ratio, and the NSFR, which is I'm just not getting the full form, but NSFR, which is NSFR stands for the stability of the funding. So net stable funding ratio. I got it back. So it was one of those blank out moments. NSFR. So that's the net stable funding ratio. So Basel came up with LCR. They came up with a supplementary LCR and the NSFR, which is net stable funding ratio. Again, not just globally, across the globe, a lot of local regulatory bodies like the RBI in India, and and its counterparts across the globe. There are a lot of stricter regulations which were enforced after the crisis to ensure that some of the things will not play out. And Karthik, I'm going to touch upon capital adequacy and leverage a little, in our Friday session. So I'll do touch upon that. But the short answer to your question is yes. Those kind of things will happen. It will happen first with China. If you are reading the news, then China is doing a huge crackdown on their technology companies, because there are multiple reasons for it, and they want to ensure that nothing untoward happens there. Even on the real estate sector, what's happening for Evergrande, I obviously expect for sure there'll be regulations, but it will take time. It won't happen overnight. The intervention could possibly happen overnight, but the regulations will come over a period of time and not tomorrow. Sure. Maybe we can
Thank
just
you,
take
sir.
a last 1 or 2 questions because it's
Yeah.
already
Yeah.
past time
Yes.
and I don't want to
Yes.
keep anybody waiting.
Okay. Mr. Mehul, good evening, and this is Anand here. And
Yeah, Anand, tell me.
at the outset, thank you very much for somebody who has a complete global view. We really heard many things, including the last question. So my first question to you is, so while you know that India is certainly one of the fastest growing economies and globally in the top 4-5 position. And while we see a lot of FII investment coming into the equity kind of market, I'll come to the subject. Today's subject is more on the credit ratings. However, India is not attracting enough of debt investments, either into the corporates or into the government securities and so on and so forth, which definitely, as you know, if it were to attract even the government borrowing itself will be much lower than what it is today, and maybe RBI may not have to do the OMOs or whatever. So definitely somebody like from JP Morgan is better positioned to comment on this one. And my second question quickly also I'll summarize. While we all agree that bank are the backbone of the economy, when banks perform, economy performs. When banks break, economies break. That was a prior question that happened in Lehman Brothers time. Then why is it that, again, you are the right person to answer, why is it the bank's PE is much lower than any other sector, even though they make or break the economy? So these two are my humble questions to you. I appreciate your reply and looking forward.
Sure, Anand. Yeah, I mean, so let me first again categorically say that this is absolutely my personal view. It has got nothing to do with.
Sure.
I don't represent my prior organizations now.
Yes, absolutely.
So, your first question, I think it's a valid question, and I think I will try and answer, and I know the logic behind it. So, why there is a restriction on debt investment in India, whereas in equity markets the government or the regulations allow investors to invest? Now, even if you look at it, say 20 years back, Anand, there were even for the equity market perspective, there were significant restrictions on what FIs could invest in terms of sectors. Even today, there are sectors where there are FI caps. Even today, there are sectors where FIs can't invest. So the equity market has actually been opened up, but the debt, has not as much opened up. And there are two, the two things which I can think as to why the government is doing it. The first part is equity by definition is considered as a risky investment. So, you'll obviously have hot money flowing in and going out. Credit by definition is not as risky as equity. I think also what happens is that if there is hot money flow which is coming in and out, very quickly, and that could happen if you have FIs investing in equity. That could impact the equity markets, but equity markets are defined to take risk, whereas the debt markets are not. So you really cannot have hot money coming in to the debt markets or credit markets. So from that perspective, you'll see that in 1 month, if I invested, say, for example, 10,000 crores, in the next month, they actually pulled out 5,000 crores. But you cannot have the debt market functioning in that way. That could cause a lot of pressure on the entities. So that's one of the reasons. The second reason, which I think is also that, if you look at the debt markets and the equity markets, my logic is that, so there is a restriction right now. I don't recollect, but at some point in time, it was about $2 billion or something, which 2 billion or 5 billion, I think, which all the investors can invest in India in a year. Okay, I don't recollect. I'll have to check my numbers there. I'm not very sure, so I'm just hazarding a guess. But so at the national level, I'm presuming that RBI or the Ministry of Finance are comfortable with that much amount of money coming in, nothing more. So it's a call which is taken by the government and the central bank as to what amount of money India can absorb, what amount of money is sufficient and right. So I remember it was actually $1 billion or $1.5 billion earlier maybe, but which went on, which was increased. I think it is about 5. I'm not very sure, but that's an assessment which they do as to how much money they are able to. The country is okay to kind of let the foreign investors invest. So those are my 2 reasons as to why there's a limit or a cap. Again, the limit is there even on FIs for equity. Now coming to your second question, Anand, as to low P, that's more about to do with the model. So if you look at a bank, and I'm not going to spend too much time. If you look at a bank, the bank's business is largely, the valuation is driven out of the book value and the future rise in book value, and not so much in terms of the future rise in the earnings. So earnings is obviously important. You don't want to have a bank which is incurring losses. You don't want to have a bank which is incurring credit losses. But from an investor's perspective, when you look at a bank, you're not looking at dividends, you're not looking at earnings, you're essentially looking at the value of the bank. And see, if you look at the value of the book value of the bank, it will also capture the future earnings, which will get added to the book value. So P is obviously a thing you will look at, and I mean, you're right. I mean, a bank's P can never match that of a, like a corporate, because there again, like when an investor doesn't look at it from that perspective. Second, there's always a lot of variability in the bank's earnings, because we saw in the example where your credit cost in 1 year was 1.2 billion, which came down to 800 million. So it's very much in the, so there are minimum regulations which are there, but banks are also allowed to provide significantly higher. So banks' earnings, typically as an analyst, you have to look through it through the cycle and not look at it on a yearly basis. So that's my view on this. Sure.
So lastly, why is there an absence of large investment banks like Morgan Stanley or JP Morgan out in India? We still continue to have only conventional banks which are less aspiring.
So I'll keep this very short. So I'll tell you what, when we said universal banks, some of the banks in the US, they are actually universal banks where they do all of these. And that is true for a lot of the banks that we have in India. Like I can tell you, ICICI Bank does investment banking. I do. HDFC Bank does. Kotak is the leader. When you look at IB from a Indian commercial bank perspective, it's just that you don't have a pure play investment bank listed in India. Okay, because again, I'll have to go back to history, but I can tell you that Morgan Stanley and JP Morgan, and this is again everything based on available in public domain. They were one entity at some point in time, and then they split into two between. So it became JP Morgan and it became Morgan Stanley, a separate entity, where Morgan Stanley became an investment bank and JP Morgan became the traditional bank. And then after some point in time, there were changes in regulations, and then Morgan Stanley started doing both banking as well as investment banking, and JP Morgan started doing everything again, banking and investment banking. So there's a very thin line now between a universal bank and a commercial bank. I mean, most of them do everything. So, and that also helps them to cross sell. And you have an IB client, you can cross sell cash management, you can cross sell working capital, you can cross sell derivatives. So that's the advantage, and everybody does everything. So I'm hoping that answers your question, Anand. I think we are way out of time now, so I'm not going to we will just stop it here. Thanks for your time, guys. If you have any questions, keep it for the next session. Maybe I'll budget half an hour to 1 hour for questions next session on Friday, but I'm not too sure Friday evening how many of you guys will be interested. But yeah, if you are, then I'll be happy to take on more questions on Friday. Thank you. I hope this was interesting and it, added something to you guys. We'll talk next time on Friday between 5 to 7. Thank you and have a good evening. Take care. Bye-bye.